In 2023, Canada's oil exports to the United States surged with unrelenting force, 4 million barrels per day, an unprecedented torrent that shattered records and commanded global attention. This wave accounted for a staggering 97% of all Canadian crude oil exports, raking in nearly $93 billion USD, even as global oil prices plunged 18% from the year before. The flow didn't falter. It accelerated. But beneath the surface of this relentless energy stream, tensions were tightening. The ground was already shifting. Alberta led the charge, supplying a mammoth 87% of those exports, with Saskatchewan trailing at 9%, Newfoundland and Labrador at 4%, and the rest scattered across British Columbia and Manitoba. A vast, aging web of pipelines kept the oil coursing through North America, none more significant than Enbridge's Mainline system, which groaned under the weight of 3.08 million barrels a day, operating at 95% capacity. The Keystone pipeline, long a flashpoint in political battles, pushed another 600,000 barrels into U.S. territory. Other arteries, Express, Milk River, and Trans Mountain, quietly fed global markets. But the Trans Mountain expansion signaled something far more dramatic. A pivot, not toward domestic needs, but to distant oceans and foreign demand. The tide was turning. Canada's natural gas followed a similar yet more precarious path. Though 8 billion cubic feet per day still flowed south, U.S. shale production had cannibalized Canada's share, slashing exports by over 25% since their 2007 peak. Gas funneled through a triad of corridors: 4.7 billion cubic feet east from Alberta, 2.5 billion into the Midwest, and 1.7 along the West Coast. But the returns were shrinking. Global prices had collapsed. Canada's gas revenues dropped 36%, falling to just $13 billion. The pressure was building. Electricity exports, once a quiet but dependable force, began to hum with a new kind of promise. Canada sent 49.4 terawatt-hours of surplus hydroelectricity surging into the U.S. Northeast and Pacific Northwest, earning $3.2 billion. Yet this too was only the beginning. Quebec's expanding HVDC lines and Manitoba's Bipole 3 project whispered of a future where renewables might rise to 70 terawatt-hours, doubling revenue and rewriting the rules of power, literally and geopolitically. And yet, behind all these numbers, the energy bond between Canada and the United States, long a model of deep integration and economic symbiosis, began to fray. Political friction bubbled. The threat of a 25% tariff on Canadian energy and resources by previous U.S. leadership shattered old certainties. Ottawa retaliated with $43 billion CAD in countermeasures, targeting politically sensitive American strongholds. The gloves were off. Canada responded not with retreat, but with redirection. Eyes turned east, toward Asia. The first bold move came with LNG Canada's $1.8 billion project, set to go live in 2025. It marked not just a trade shift, but a strategic reimagining. More LNG facilities, Prince Rupert, Woodfibre, Cedar, were fast-tracked, aimed at redirecting billions in energy exports away from the U.S., potentially reclaiming up to $38.4 billion CAD. The balance of energy power was slipping, and the world was watching. In this high-stakes atmosphere, Prime Minister Mark Carney emerged with a bold, divisive message. In an exclusive interview, he made it clear: Canada's energy future would no longer hinge solely on fossil fuels. It would be broad, strategic, and sustainable, anchored in oil, yes, but also nuclear, hydro, carbon capture, and clean innovation. A bold vision, but not without cost. Critics bristled. Oil-rich provinces like Alberta and Saskatchewan feared marginalization. The controversial Trans Mountain expansion raised questions about whether Canada could claim environmental integrity while doubling down on old infrastructure. Carney pushed back. With decades in global finance, he insisted this wasn't about one project. It was about rethinking the entire system, one that included Indigenous partnership and national unity. It wouldn't be easy. It might not even be popular. But it was necessary. Still, fractures widened. Political tensions sharpened. Trust eroded. And yet Carney held firm. "We can't afford to be paralyzed by rhetoric," he said. "We must be defined by results." Now Canada stands at a defining crossroads. One path leads to continued dependence on its southern neighbor, a known, reliable but shrinking market. The other, to a risky but transformative future, one that could recast the country as a true energy superpower. The stakes? Nothing short of global relevance. But amid this urgency, one truth looms larger than all others. Speed without scrutiny is a dangerous illusion. Environmental assessments, once dismissed as red tape, are now recognized as critical. The Harper government learned this the hard way. Rushing forward without clarity only leads to collapse. The clock is ticking. The pipelines hum. The markets shift. and Canada's energy destiny teeters. Carney's declaration didn't land quietly, it detonated. A bold shift in regulatory philosophy, a calculated gamble that sent tremors through Canada's entrenched status quo. Gone is the piecemeal approach. In its place, a sweeping commitment to rely on provincial environmental assessments as appropriate. But make no mistake, this isn't a procedural tweak. It's a seismic pivot, one that could unleash a surge of long-stalled infrastructure projects, each with the potential to redefine Canada's future. The strategy? Streamline, eliminate redundancy, outflank legal bottlenecks, accelerate development. But beneath the technocratic language lies a high-stakes gamble. Can Canada fast-track its energy ambitions without fracturing its climate commitments? Carney insists collaboration is the only way forward. Federal and provincial leaders, Indigenous partners, private industry, all must lock arms. The stakes are too high for discord, he warned, drawing on recent talks with Saskatchewan's Premier Moe and Alberta's Premier Smith. The early signals? Promising. A fragile coalition might be forming, one strong enough to break policy paralysis. Carney doesn't waste breath on lofty rhetoric. Let's stop talking, he said bluntly. Let's roll up our sleeves and work, together. No patience for political theater. No room for delay. The message: act or fall behind. As tensions escalate at home, the international stage simmers. Canada's relationship with the United States, especially under a potential Trump resurgence, hangs in precarious balance. There were challenges, both good and bad, Carney conceded, carefully avoiding partisanship. But his posture is clear, pragmatic, unflinching. He'll negotiate, adapt, and defend Canada's interests with steel-eyed resolve. The USMCA is non-negotiable. So is Canadian prosperity. Domestically, the political terrain is shifting. A post-election exchange with Conservative MP Pierre Poilievre hinted at future engagements, but the power chessboard remains unsettled. Despite Poilievre's lack of formal opposition leadership, Carney signaled a willingness to engage across party lines, particularly with Andrew Scheer. Substance over optics. Legislation over slogans. But beneath the politics lies the real tension. The thicket of regulations that continues to strangle Canada's energy potential. Federal emissions targets are ambitious, some say unattainable, clashing with the brutal realities of market demand and pipeline scarcity. A 35% emissions reduction mandate for oil, gas, and LNG operations by 2030. A looming cap-and-trade system. And most daunting of all, a 75% methane reduction target by decade's end. The grip is tightening, and with every new rule, more investment risks fleeing to... This isn't a policy debate. It's an economic knife fight. Pipeline capacity is already stretched to the breaking point. Keystone XL is dead, Energy East derailed, and Canada's natural gas remains shackled. Over 8 billion cubic feet per day funneled southward, locked into North American pricing, while the world clamors for LNG. The LNG Canada terminal in Kitimat offers a flicker of hope, shipments expected mid-2025. But it's navigating a gauntlet of logistical and financial hurdles. Until more liquefaction facilities come online, Canada remains tethered to an American energy umbilical cord, draining opportunity by the day. The pressure is immense. Stringent environmental rules, choked pipeline corridors, a crippling lack of LNG infrastructure. Canada is at an inflection point. Can it reconcile climate ambition with economic necessity? The answer depends on regulatory clarity and unprecedented federal-provincial cooperation. The question isn't if Canada can adapt, it's whether it can adapt fast enough to stay in the global game. But Canada's energy wealth isn't a one-note song. The oil sands still dominate, 165 billion barrels strong, and hydroelectric power surges from more than 83 gigawatts of installed capacity. Nuclear remains a formidable asset, and renewables, wind, solar, storage, are accelerating, driven by large-scale initiatives in Ontario, Quebec, and Alberta. Yet even as clean energy rises, the hydrocarbon heart of Canada's economy beats on. In 2023, crude oil production hit 4.2 million barrels per day, feeding billions into national coffers. The future doesn't belong to one form of energy. It belongs to those who master the transition. The path forward is narrow but navigable. It demands more LNG terminals, expanded pipelines, smarter transmission grids, deepened partnerships with Indigenous communities, and above all, integration of cutting-edge clean technologies to drive down emissions in oil sands operations. Carney's vision is unmistakable. Not just bold leadership, but coordinated, relentless action. This is Canada's moment to prove it can lead, not lag. That energy prosperity and environmental stewardship are not mutually exclusive, but interdependent. The world isn't waiting. Neither should Canada.